Good morning. It is Monday, June 1st, 2026. This is your deep dive daily briefing. I am your anchor, delivering a comprehensive analysis of the pivotal events that have defined the last 24 hours. We begin our broadcast on the world stage, where the strategic and legal architecture of the Middle East faces an immediate operational test following the official implementation of the Doha Memorandum of Understanding. Over the weekend, Naval Command Centers confirmed that the temporary ceasefire between the United States and Iran has successfully frozen offensive kinetic operations across the Persian Gulf. However, the international community remains on high alert as the 30-day window for the verifiable removal of sophisticated sea mines from the Strait of Hormuz officially begins today. Diplomatic monitors from Pakistan note that while Tehran has instructed its maritime forces to comply with the transit protocols, the physical presence of hundreds of unmapped ordnance fields presents an extreme hazard to commercial shipping. United States Central Command has emphasized that any deviation from the agreed terms or any incident of hidden sabotage will instantly void the accord, keeping regional security on a highly monitored and strictly enforced timeline as international observers arrive to oversee the clearance.
Transitioning from the tense waters of the Middle East to the broader global economy, the structural damage inflicted by months of maritime gridlock is forcing international policymakers to confront an unprecedented supply deficit in industrial raw materials. According to supplementary trade data released by the World Bank, the prolonged closure of major shipping lanes has triggered a severe contraction in manufacturing inputs across advanced industrial hubs, particularly in East Asia and Western Europe. This systemic deficit is heavily constraining the baseline productivity of automotive and electronic sectors, which are struggling to maintain production schedules due to a historic shortage of oil-derived components. Economists warn that while the signed ceasefire provides substantial psychological relief to global capital networks, the cumulative inflationary pipeline built up over the past 3 months will continue to exert a stagflationary drag on international growth, forcing governments to aggressively review their industrial buffer strategies to prevent a long-term economic slowdown.
This environment of industrial supply shocks and pending structural adjustments is dictating the immediate policy path across international financial markets, where energy anxieties are colliding with an insatiable appetite for advanced digital infrastructure. On Wall Street, major equity benchmarks maintain their momentum near record highs as institutional investors process the initial decline in crude oil benchmarks following the diplomatic signature in Doha. However, the sovereign debt arena remains highly complex as the Federal Reserve under the leadership of Kevin Warsh signals a prolonged period of monetary discipline. Bond managers are adjusting to a restrictive financial reality where long-term Treasury yields remain sticky, reflecting an underlying market consensus that structural wage growth, elevated defense expenditures, and massive capital expenditures pouring into localized supply chains will keep baseline inflation sticky, completely eliminating any expectations of a near-term interest rate cut.
Turning our attention to the technology sector, this relentless push for infrastructure density is driving an unprecedented corporate and regulatory transformation to sustain the artificial intelligence supercycle. Industry analysts report that global capital expenditure dedicated to AI data centers is projected to approach historic levels this year, transforming technology transactions into core instruments of national security and regional market access. To bypass traditional power grid constraints and protracted permitting delays, tech conglomerates are aggressively accelerating their energy independence strategies, entering into direct partnerships for advanced localized power systems. This strategic pivot highlights a new operational reality where technological leadership is no longer judged solely on software and algorithmic sophistication, but on the geographical security of advanced testing, packaging, and self-sustaining energy infrastructure capable of insulating digital assets from global energy volatility.
Finally, we look at the logistics and supply chain networks that serve as the vital arteries of global commerce, which are now confronting the massive operational challenge of transitioning back to traditional maritime routes. Despite the signing of the Doha Agreement, major maritime carriers have confirmed that the Cape of Good Hope detour will remain the default operational baseline for all Asia to Europe trade lanes through the month of June. Shipowners warn that the physical process of clearing naval mines from the Strait of Hormuz and reorganizing global fleet schedules will take weeks to safely execute, meaning that maritime transport insurance premiums will remain elevated for the immediate future. Consequently, logistics professionals report that global freight networks must manage a dual reality where spot container rates are moderating on peace optimism,
while the physical flow of world trade remains capacity-constrained, forcing enterprises to rely on high-cost regional inventory buffers to bridge the gap until the international corridors are fully verified as safe.
In summary, the global landscape is defined by the commencement of the 30-day mine clearance window in the Strait of Hormuz under the Doha Agreement, occurring as the global economy grapples with a severe deficit in manufacturing inputs. Financial markets remain near record highs despite sticky bond yields, while the technology sector accelerates localized infrastructure to sustain the AI boom, and the logistics industry prepares for a complex, multi-week transition to safely restore traditional shipping routes. Based on the current trajectory, I predict that the physical reality of clearing hundreds of sea mines from the Strait of Hormuz will prevent a rapid drop in global logistics and manufacturing costs this summer. The decision by major maritime carriers to maintain the Cape of Good Hope detour through June proves that corporate leaders are prioritizing operational certainty over political announcements. Furthermore, the deep systemic damage suffered by the industrial supply chain due to months of material shortages cannot be instantly repaired by a signed treaty. Therefore, while equity markets are celebrating the diplomatic breakthrough, the Federal Reserve is highly likely to maintain a highly restrictive policy stance with elevated interest rates through the remainder of 2026, recognizing that underlying core inflation and the massive structural capital redirection toward resilient infrastructure require a prolonged period of monetary discipline.